So we're at our last segment of the morning's session, our CFO panel. So we've got three distinguished CFOs who have gone through the IPO process, I think within the last 12 to 18 months. So it's very fresh on their minds. They've got a lot of good battle scars, I guess I'll say. I've got some questions. I know they've got a lot of information that they'd like to share with you, but if there are any questions from the audience, please raise your hand and we'll get to them. So maybe I can start with introductions. Mike, maybe if you want to just, we can start with you. Company, kind of the IPO process, the timeline that you went public, and any other relevant information that might be helpful to the audience.
Hi, everybody. Is this working?
Can we hear me? Yep.
We're good. Mike Ellis, I'm the CFO of Flywire. I've been with the company for about 7.5 years. We're basically a global payments enablement and software company that basically focuses on the accounts receivable side. We basically operate in 4 verticals: education, healthcare, travel, and B2B. And we basically help our clients get paid anywhere in the world and really help their payers have a good user experience in doing that. So we went public in May of 2021, and that was after, I think, 5 private rounds. We had investors including Temasek, Goldman Sachs, Spark Capital, Boston-based firm, and then went public into the public markets just based on, even though it was during a COVID pandemic, based on the strength of the business and the verticals in which we operate. But that's basically me and Flywire. I basically had 10 years in public accounting, 17 years in a fintech CFO role. It was my first successful IPO. My failure, as everyone who's over the age of probably 45, happened at the .com crash. Got to pricing in March of 2020 and 2000, and then the whole market fell apart. But that's my story, and I'm sticking to it.
Thanks, Mike. Jeff?
Thanks. Jeff Trigilio. I'm the Chief Financial Officer of Cullinan Oncology. We went public in January 2021. So great market. We didn't really have any battle scars other than from our auditors, maybe. Just kidding. Yeah, I've been with the company for 2 years. As the name implies, we develop medicines for cancer, and we've got 3 programs in the clinic. Our lead one, we announced some good data on it last year. It's for patients with a rare form of lung cancer. And on the back of that, we did a big collaboration with a Japanese company. And now we're looking forward to moving the next 2 to that stage as well. So nice to meet you guys.
James?
Good morning. James Haley, CFO of Desktop Metal. So Desktop Metal, we do additive manufacturing 2.0. Our roots are in additive manufacturing for metal, but we also do polymer, rubber, sand, wood, you name it. We're biofabrication. So we actually went public in December 2020 via SPAC. So we had a very, very successful SPAC, much different than what the world is today. So in terms of our SPAC, we had about 1% redemptions, where today I think they're 70, 80, 90%. So much different then. Desktop Metal, we flew out of the gate. We got our valuation up to about $7 billion off of $16 million in revenue. So to say we were a little lofty is probably an understatement. Today we're about 800 million. So excited to be here. I guess I should add about 15 years ago, as part of the team to take A123 Systems public as well. So that was another high flyer. We got that up to about $2.7 billion valuation. And unfortunately ended up in bankruptcy court probably 4 years later as part of the evolution of batteries. We were probably 10 years too early. Yeah. But excited to be here and share.
Well, thank you. Yeah, I remember those days as well. It was in the late 90s. I was a second year associate at KPMG, and I worked on a lot of those IPOs of companies that unfortunately are not around anymore. But I think this vintage is much different. So in that vein, Mike, maybe we can start with you. Tell us about the thought process you went through of going out and raising money via an IPO versus continuing to raise money via your existing stable of venture capital or private equity investors.
Sure. So really, it comes down to the length of the life cycle of a company. So we were basically 8 years old at the time. We had some real long-term investors and a really good pedigree as it relates to the investor quality. And we thought we had a really solid business. And what we did was we thought it would be really good to be a public company. And it's really interesting as you start in an early stage business. Unfortunately, the ultimate goal is to grow up and be a big business. And getting your employees to kind of embrace that is kind of challenging, but we felt like we made that hurdle. We were also, have employees and clients all over the globe, and really some of the strategic reasons on why we went public, not only for potentially providing our shareholders with liquidity opportunity, but also for name recognition across the world with respect to being a private company. You all know it's hard to sometimes get potential clients to take a risk on you, and you're like, well, we're a private company, we don't give financial statements. That was slowing us down a little bit. And we just felt as though no matter what, you have to be operating and prepared to be a public company, no matter what, because the two questions that you'll always get are you ready? And why haven't you invested in the proper systems to safeguard the company, whether you're private or public? So it really just came the natural maturation process of the business based on the strong fundamentals and the opportunities that we saw in front of us with respect to addressable markets.
Okay. Jeff, maybe any differences, obviously you've got the life sciences background on, what was the right inflection point where you look to the public markets to raise money versus continuing on private money?
Sure. Yep. So drug discovery takes a lot of money, and we're always looking to raise capital. And so the thought was in the public markets, you can do that at a higher valuation, and so it's a lower cost of capital. And we looked at everything. We looked at a SPAC. We looked at a reverse merger. We looked at just going straight to an IPO. And I think the tricky thing with SPACs are, as you probably know, is you have to find them where they have the right investors that kind of match the profile of your company. So there's a lot of SPACs out there, but then the question is, how many of them have those like life sciences, biotech-focused investors that are going to stick with you? So it's tough to find that. And I think the other side of the coin is, we had really good clinical data, and the market was pretty strong at that point for biotech companies. And so we went with the IPO because it gave us a better valuation. Along the way, we looked to do what's called a crossover round. And so for people familiar with biotech, they probably know about this, but there's kind of three groups of investors. One are the early stage VC funds, like for us it was MPM that founded the company. And then on the other side of the spectrum are public market investors, some of your larger mutual fund complexes like Fidelity, T. Rowe, Wellington, et cetera. And then kind of in between are the specialists. And when I got there, we didn't have a lot of specialists in our investor base. And so we thought in order to put our best foot forward with the IPO, we would bring some of those folks in for a Series C investment, which we did in December of 2020. And what that did was it allowed the public market investors who were going to see us at the IPO to kind of see that there was some validation that there were really smart, thoughtful, leading life sciences investors that had put money in the company privately and that were going to commit to then put in more money at the IPO. So when we launched the IPO, we were thinking like $150 million raise. And from those existing investors from the crossover, we had like $400 million of demand. So we could go out to the market with a very strong message that, our book was oversubscribed, and that if you wanted to be in, you had to, have a big order and have no price sensitivity. And so, we ended up raising, I think, close to $300 million, and we priced about $2 above the range. And I think, that was a really helpful thing. And then the quantum of capital that we raised feels really good in this market right now because the tides have turned, and we're very well capitalized. We've got runway through 2026. So one piece of advice I would give folks is the more you can spend time with your board ahead of raising money ahead of an IPO, and avoid the D word of dilution, and just say whatever's on the table, we're going to take it, because it's sunny today but it could rain tomorrow. I think the more time you could spend with your board members ahead of time and getting them sensitized to that, the better. Because the tension will always be, well, hey, we think this stock is going to be worth a lot more in the future, so why don't you not raise as much now and wait till later? And that might be true, but the capital might not be there later too. So,
right, great. James, you mentioned obviously you had a successful SPAC outcome. There's still some SPACs out there. I was actually involved in a transaction this past summer. But maybe you can help us, the group, understand the thought process of, okay, we took the SPAC route because of X versus a traditional IPO route. Sure.
So it really came down to timing. So when we kicked off the process, it was summer 2020. Really, right on as we were coming out of lockdown. So like many companies, we did a big RIF where we took out probably 40% of the workforce, not knowing how long the shelter in place would be in place. So we coming out, late July, we engaged a dialogue with bankers, and there was a huge appetite for DM to go public via the SPAC route. So, multiple discussions with various sponsors was a bit of a bake-off, and then we ultimately did a transaction with Trine, which was Leo Hendry, TCI Cable, a really great guy. So that the sort of de-SPAC proceeds brought in about $575 million. Stock took off. De-SPAC was obviously at $10. So we had a really premier pipe as well, because we had lots of strong VCs. We have NEA, we have Lux, we have Kleiner. Jeff Immelt is on our board, so we're really the darling of the SPAC market. So very oversubscribed pipe. But at the de-SPAC, $10. 4 weeks later, we were at $34 a share. So naturally, most of the folks in the pipe immediately rang the register and said thank you. So that definitely was sort of an unforeseen challenge with it, because when you have Miller and Ron Barron and all these guys you're talking to, and you think they're going to be in it for the long haul, and they're flipping their shares, it's a real challenge, and that obviously sets things in motions. I think honestly, the SPAC route for us also made sense, just where we were when I joined the company. Over the course of the summer in 2020, there were 2 people in finance after the RIF, and we had to get public essentially in 4 months. So we leveraged Mark Dumaine and his team, virtually rolled in an army of people that really took over and really helped us with all the registration statements, Super 8Ks. Mark and his team just do a phenomenal job. And I, during that time, had to build out a team, because obviously, Mark's great, but he can be expensive too. But well worth it, Mark, well worth it. So then we just hired up, and we're off to the races. Had we gone the traditional IPO route, it probably would have been another, 18 months to 2 years.
No, thank you for that insight. Mike, in an earlier session, we were just kind of going over the basics of the S1 drafting process, and the attorneys from Goodwin and the bankers from JP Morgan gave a lot of good insights. Maybe help us understand, if you look at the entirety of that document, where did you spend the most time? What do you think was the most important story to tell to make sure that you had a successful outcome?
Yeah, like most accountants, I spent most of the time in the F pages.
Yep.
However, being at the table with all of those brilliant people, really leveraging the strengths of your team and understanding the direction and the long-term trajectory of the business is really critical. And really that upfront business section, that's really going to get people excited about the opportunity. And then the other big area outside of making sure that the accounting statements were in fact appropriate is really the total addressable markets. And a lot of the time that you spend kind of going through trying to evaluate what the opportunity looks like in front of you, and then understanding that the diligence side is going to be coming right after that with the underwriter counsel. So really making sure that not only your financial statements accurate and everything, but the veracity of any other types of information that you're kind of putting in that document is up to par from an underwriting standpoint. But yeah, those are probably the 2 biggest areas: the business section and, of course, the MD&A
Right.
and the financial statements. But they're all kind of tied in with each other. So.
Mm-hmm. Jeff, I have to imagine it's probably a bit different flavor, right, in life sciences with Cullinan versus...
I'm the only one that looks at the F pages. Me and Jen. I think Jen and I are the only ones.
Yeah, right.
Yeah, so I think building on James' point, like number one, if you're the CFO of a company, get help. Like get a firm in that can help you Edgarize your statements. We use CFGI, but I'm sure KPMG does a great job at that as well. But there are auditors. But yeah, get help. It's the best investment you'll make, because speed is everything when you're trying to get ready for the IPO. And then for us, yeah, and the business section is the most focus for life sciences investors. And, there's a tendency from your team to want to put everything in there. And so less is more. And, keep reminding them that everything that's in there has to have a source and a footnote. And it's going to go through your counsel, underwriting counsel, et cetera. So the more backed up it is, the better. And then the one thing I would say about the org meetings is it's basically a friendly audience. Your underwriter counsel, I don't know, it depends. But it's a good opportunity to kind of like test the story out a little bit and get feedback at that first org meeting.
Right. Okay. We had mentioned on an earlier panel kind of being ready for audits and, just understanding what type of audits you've been historically performing, whether they're private company audits and whether we have to upgrade them to public company audits. I'm sure you guys went through that same thought process, but I'm just curious at what, how far in advance did you go to your auditors and say, hey, look, I know you've been auditing us for a while under private company standards. We're thinking about doing this type of public fundraise. We need to get SEC, PCAOB compliant. Maybe help us understand the timeline that you started having those conversations with the auditors, and any advice for the controllers and the CFOs in the room regarding that process.
Maybe like 2 days before our org meeting? I don't know, something like that.
Cullinan was an audit client that told us they would never go public. We got a phone call, we have an org meeting in 2 days. So it was quick, but I think we did a pretty quick upgrade.
Yeah.
It was hopefully painless. It's a little easier on the life sciences.
A little easier in life sciences, but maybe more applicable to Mike and James on that.
Yeah, so we went through a change in independent auditors in 2018. In connection with that, I went from Ernst & Young to PwC, and I basically told the PwC partner in 2019 audit that I want PCAOB audited financial statements. And they said, we can do that. It's going to cost you a lot of money. I'm like, that's okay. And we basically took a bleed-in approach. So the PCAOB, not full standards for 2019, but 85% of it. And maybe instead of like 100% of all required testing, they did what was necessary for private, but got up to about, in between the 2 points. And that's really how we did it. So, and that happened in 19, and then our financial statements that we included in the S1 were 20 and 19 anyway. So it actually worked out. The timing was lucky more than anything. I don't think I would have been smart enough to know that they needed to do that sooner, and I probably would have been harder to kind of get the financial statements up to speed in the time frame that we did it. We basically hired underwriting counsel last week in December, and we went public May 21st. So we hit every single milestone, and to be able to get a traditional IPO done roughly 5.5 months.
Yeah, we had said in an earlier session, the finance folks and the auditors get blamed for everything. So expect that, and anything you can do in advance to mitigate that was certainly warranted.
Yeah, I would just.
I just wanted to say, just push your technical partners at your public accounting firms, because they're always going to be throwing the yellow flags up. We're not going to be ready. We're not going to be ready. But just keep pushing them.
Keep pushing.
They'll get there.
Yep, that was definitely a point I was going to hit on. So I think both at A123 and Desktop Metal, it was really a multi-year journey, right? Yeah. At the outset, as soon as you have dreams and aspirations at DM, we were, for a long period of time, we were the fastest unicorn of all time, had $1 billion valuation 18 months after founding. So really at that point, which was ahead of my time, working, Deloitte was the auditor both at Desktop Metal and A123, but starting early. Start where you know you're gonna have issues. 409A, David Roy and his team, Mark, great job. I'd highly recommend them. Similarly, RevRec, your cap table, all the stuff that is going to trip you up. That is what takes forever. So, get those things done early. I have found that the big four firms will always give you a nice discount, pre-IPO, with the expectation that on the other side, the fees are going to ratchet up, and they do pretty dramatically, but they do make an investment in you, right? And when cash is especially scarce early on, they're willing to work with you. So I would start early. And obviously PCAOB, you got to do it. You gotta incur the additional cost, because if you wait, it's forget it.
I'd also add that it's just plain good corporate governance to have a really good internal control system and structure. I think the battle that we all face as a private company CFO is we'll just get it done, right? I'm not going to go to the CEO and tell him I need $1 million here and $1 million there, and we just kind of just do it, right? We just roll up our sleeves, we work weekends, and we're just killing ourselves. We kill our team. It's the last thing to get invested in. And really, it's just a change in mindset. Start making your arguments. Tell them now that it's just good corporate governance. I'm required to safeguard the company's assets, and this is an important investment to the business to ensure that happens. And don't wait. That's the mistake that I always made. And the other thing where I made another mistake is probably investing in internal tax resources. Taxes are a pain. They're always going to be there. And there's just, as an accountant by trade, so many things I just didn't know. And you just need to get that in-house because no one's thinking about it 24/7 as an external provider. We had a contractor for 4 years, great person, but not someone that was in there all the time. So those are really two things that I really struggled with is like saying I needed help, and number two, I don't know tax.
Yep.
Can I just chip in one thing too? Is on that front, building on that is like cutoffs and getting interim financials done, super important. Like I joined in September of 20, and so we were debating like for our first filing, which is confidential. Do we just put in the 2 full years of financials, or do we do interim? And I don't know who's here from Goodwin, but our partners were Mitch Bloom and Daniel Lazan, and I was coming in, guns blazing, saying we don't need interims. I could show you all these examples, and they counseled us that we should, and I'm really glad we did that because it got that in front of the SEC early, and any issues around that were cleared early, and then B, to your point, it kind of just got the company used to like accruals are important, like this is why. So
Can't do it once a year.
Yeah, so yeah. I would just really underscore that, like do your interims as much as possible.
That's great insight. So when we think about the actual, now that the S1's been filed, 30 days, the SEC gets back to you. If you guys can think back to when you got that first comment letter, maybe your experience there, what surprised you, or maybe nothing surprised you. Any areas on the financial statements that required rework. If you think back, maybe you can just share some of your thoughts there. Jeff, if you want to start from a life sciences perspective.
I think ours was pretty balanced between like business and finance stuff, and it wasn't anything that unexpected. The one thing I would say, 409As become really important because you want to do a really good like cheap stock letter with the SEC, especially biotech valuations are just the most volatile thing in the world. So like your valuation can move a lot for the IPO. So just having a good narrative on how the stock price hopefully accreted in value is really important.
So yeah, I would say my experience at A123 was it was a very robust process. I mean, it took us from our org meeting, and granted, it was during the midst of a financial crisis, but it took us effectively 18 months. But our first comment letter was north of 50 comments. I mean, it was. Because it was, nascent market, trying to conquer the universe basically between automotive, grid scale, energy storage. A lot of the comments were really some of the things we've been hitting on, substantiation for sure. So that's where you need to make sure you've got good documentation for all of your claims, right? So that was a big one. 409A for sure. Cheap stock always pops up. At least that's my experience. Or they're going to want validation and support. Financials weren't bad. On the DM side, given that it was a SPAC merger, it was much more benign. We may have had one or two, nothing substantial.
Mike, anything unusual on your end?
Yeah, we got very few comments. I guess
wow.
that's
Good for
unusual.
you,
We got, I think, 9 or 11 comments on the first letter and 2 on the second one. Not even a 409A question, and nothing really substantive at all in the financial statements.
That's great.
So I don't know if they just weren't looking at us or were too busy, but
Oh, give yourself credit. I think you did a fantastic job. We talked earlier today about building out the board of directors, audit committee. Maybe could we get some insights there on, when in the process did you guys think about that? Who you wanted on the board? Did you have any input, or was that outside of your control leading up to the IPO?
I'll take it. So we pretty much, as I mentioned, we had a lot of blue chip VCs. So we pretty much maintained the board. We picked up one board member via the sponsor, Trine, Leo Hendry, which was a great addition. We did also add Steve Nigro, former president of HP, and then what we did add was sort of the audit committee chair, Scott Dussault, who's been a great audit chair. So I think that is probably the biggest area of focus for us. But otherwise, The board is pretty much intact. We did have a couple of folks that needed to step down just because of governance reasons. So we also had Koch Industries on the board, Ford Motor Corp, and Google Ventures, but they all part of their mandate once you go public had to step down.
Anything to add, Jeff? Or
No, I just thinking, when you're moving from like kind of VC to public company, the more you can find somebody who's actually been like a CFO of a small company, not just like a VP finance at a huge company, but who's actually been through this stuff, make that person your friend. And I talk to our audit committee chair like every 2 weeks, just even if there's nothing going on, just to make sure he knows he can reach me and then I can reach him.
right.
Yeah, so we always had an independent chairman, and he basically not only did he chair the board, but he also facilitated the audit committee chair role. We didn't hire a true audit committee chair until the month that we went public. But we had good governance before that, but really not the expertise. But I would echo that you got to have good communication with your audit chair.
Right. Good insight there. So now that you're public, anything surprise you? We talked earlier about just the deadlines to get 10Qs out, 10Ks out. You obviously don't have the luxury of unlimited timing to get them out like you were as a private company. But anything in that process, we had heard earlier about making sure to build out the right teams, because obviously it's a much quicker timetable as a public company than a private company. Maybe Mike, if you want to start with that.
Sure, I think one thing we haven't talked about is really the FP&A function. As you think about actually going public and then actually operating as a public company, is your ability to kind of model the business is really critical, and really having that good fundamental modeling skills, whether you have it yourself or you're probably not going to have time to do it yourself, so you're going to need people that you can rely on and trust. But that's really a big aspect of operating as a public company. The veracity of your forecast are just so scrutinized, and I can't tell you how bad it is if you don't hit a number. The other thing that I would suggest is really trying to identify the real important key performance indicators of the business, the ones that you potentially might want to share with a public investor, which may be different than what you've shared historically. And again, kind of being able to forecast it out, relative risks associated with them being up and to the right continually and for a number of quarters in the future is really, really critical. But I think that's really outside of closing the books, which I imagine we all know how to do and can do, and barring unforeseen issues for accounting purposes, you're going to get that done. But really where you're going to be held accountable as the CFO and the mouthpiece of the business is going to be your ability to forecast the business and hit your numbers.
That's a great point. Yeah, if I could just add to that, Mike, the more you can integrate FP&A with, we all love accounting. We're all accountants, right? But the more you can integrate FP&A in the close, the better. Because they will, even if it's like the books aren't closed yet, they roll up the P&L and they notice there's a huge variance. Like, that can help you identify a missed accrual or missed prepaid or a missed contract or a missed invoice or whatever. So the more you can pull FP&A into the close, the better. The other thing I would add is 10b5-1s are good because you can kind of get some visibility into your Section 16 officers and who's thinking about liquidity post an IPO, and trying to manage that away from the lockup expiry is really good, so that you don't get the Seeking Alpha headline that your founding CSO sold stock the day after the IPO lockup. Like, the more you can kind of manage that, the better.
Yeah. Mike, you had mentioned earlier while we were chatting outside, year 2 following the IPO, you're subject to SOX reporting. We had touched on that in an earlier session, and maybe if you could just share your thoughts there on, when did you start thinking about that? Did you more or less outsource it? Are you looking to bring it in-house? Because for a company like you guys that had a wildly successful IPO, you're not going to be able to enjoy that 5-year safe harbor, and it could come as quickly as year 2 following the IPO.
That's exactly what happened. So we went out at 24. We got as high as, I think, high 40s, and we're still right around in the 20s. I think today we're around 22, so relatively successful still. On the one hand, as the CFO happened to deploy SOX, I'm like, it's not that bad if it's go down, for June 30th measurement time frame. Maybe we can get there. And I was like having a couple of guys on my team kind of just figure out how low does it have to go in order to avoid the large accelerated filer. Unfortunately, it didn't get that low. Fortunately and unfortunately,
yeah, right,
of course.
Right.
But so we had to deploy a full-fledged SOX deployment and now accelerated filing. The good news is that like I said earlier, preparing your company, whether you're private, going public, trying to sell it, raising capital, good corporate governance is required in every single one of those, right? There's really nothing new that you should be thinking about as a public company versus a private company if you want to have a good functioning finance, good controlled environment. And depending on how much time you have, unlike Desktop Metal that did it so quickly, I had the luxury of having 7.5 years with the business, 5 years prior to being IPO to kind of make the changes I thought was necessary, make the investments, et cetera. But SOX is no small undertaking, right? So no matter how good your systems are, they're just not documented to the level that they need to be documented. So we had to go and outsource and augment our internal staff, and we used CFGI to help us with that. And they did a pretty good job, but a lot of off-the-shelf stuff that had to be customized and too much technical references, and anytime you get a memo from an external provider, it's always too verbose, and you need to kind of get it right down to where it needs to be. But similar in this case, our first cut at it. So what you do is you go identify all of your internal controls, and I think the first cut was somewhere north of 300, and we said, no, it's got to be somewhere between 100 and 150. I think we got it down to 170. But so we had to document all of those different controls, and you have to have 2 tested quarters. So really 9/30 was our drop dead date. We had to have everything documented, reviewed by our auditors, ensure that the controls were in place. So we have 2 quarters because we have to get audited for Q3 and Q4, and then we have to file. But it's no small undertaking. I don't think you'll ever be prepared for it. What I would suggest is that you don't do it yourself and get people that have been there and done that, because that's what's really going to be important.
One thing I would add that you should consider immediately is deploying a tool like Flowcast or Blackline, because those, you start that process early, a year in advance of going public, your teams will be familiar with the processes and requirements, right? And you can see immediately, all reconciliations have been, approved and double checked, double signed, but it's a challenge for sure. We are NYSE listed, so there is actually an internal audit requirement being on NYSE as well. We do outsource, so we use RSM. They do a great job, and I think for most companies it's very difficult to staff internally out of the gate. You generally have to start externally and bring it in, as the team gets more and more familiar with the requirements, but definitely leverage software.
Right. No, that's good insights there. I'll ask any questions from the audience members. Okay.
Quite a bunch.
Yeah. I mean, it's probably an overused question, but I'll end it on the 3 of you, if I may. Anything you would have done differently looking back at the IPO process that you'd like to share with the group?
Just would have raised more money.
I particularly enjoyed the virtual roadshows. I don't know if anyone else has had to do a roadshow live and you're traveling everywhere, but the virtual roadshow was fantastic. So that was one benefit.
We hit on that earlier, that it's a complete change from
really
years of history. Right?
But yeah, what I told you earlier, the same things, is I underinvested in tax. That was a big miss of mine that I wish I didn't do. And then just making sure you got the right FP&A team to support your modeling exercises, because you think that you'll have the time to do it and you just won't, and everyone tells you that, and you're always like, you don't believe them, and then you get hit and you're like, I'm in trouble. So just make sure you're investing properly, do it early, and I think that will work well.
Great.
Yeah, I would agree with that. Just don't try to be the hero and staff yourself accordingly, because you don't want to be. Finance can be the bottleneck in the IPO, and you just don't want that to happen at all.
I think 2 key areas of focus to consider for sure. One is IR. Everybody can be the genius internally, but you need someone who's fully dedicated to dealing with the external investors, the analysts and so forth. It's a huge task. It's not really a part-time role. The other big one, I would make sure you have stock administration. You touched on 10b5-1s. I mean, that too, post-IPO. I mean, everybody's going to look for liquidity, and if Mary's dedicating 4 hours a week to it, forget it. I mean, her email is going to blow up, and making sure you have the right tool. Hopefully no one from Carter's in the audience, but we did have Carter. And, when we went public, there was a split involved and some repricing, and that tool could not handle it. So depending on the complexity of what you're doing, I'd highly recommend ShareWorks by Morgan Stanley. They basically own everyone now. They bought E-Trade, and there's Fidelity too. There's a couple of others, but you got to make sure that whomever you're using can handle, whatever is going to happen to your cap table. So.
Can I just add one other
Sure.
thing? There's going to be situations as you're going through the whole IPO process where your CEO is going to be looking to you for answers across a whole array of questions. It could be what gets included in the compensation table, what can we say in the business section, and one thing that thankfully I was. I don't know why I had the idea, but I actually had reoccurring weekly meetings with two public company CFOs. On Tuesday, I would meet with Ed McGowan, the CFO of Akamai, and I also met with the CFO of HubSpot probably monthly. And the reason why I did that is because undoubtedly every single week there was new questions that my CEO would ask me. And instead of actually having to go and incur legal costs to have a conversation with the partner there, what gets included with the comp table, you can just, hey, Ed, what's in this? How did you structure the 10B5 plan? What did you tell the executives? All these types of things are going to come up. So leverage that network. Most CFOs are really happy to help who have gone through the process. And again, for me, it was my first successful time. I needed help, and that's a humbling thing to say for people that are as successful as all of us in the room. But I think it's really important because you don't know everything, and there's someone out there that knows it, and they can help you.
Sorry, just one other thing too is just building on that. Don't forget that you and your CEO get to allocate the stock. So I don't know if the JP Morgan team is still here, but the bankers don't allocate the stock. You get to make the decision. So ideally it's folks that you can have a personal call to and say, we're giving you these shares. It's a hot deal. You're getting an allocation. We hope to see you in 6 months in the shareholder filings. Just don't ever forget that it's your decision.
That's great. Well, panel, thank you. Great insights. Thank you for joining us.